Hello, welcome back stateside to the one and only Rob Beardsley. We are live here on episode 11 of the Capital Spotlight podcast, hosted by myself, Craig McGrother, and the one, the only Mr. Protect Philippe Suit Supply himself, Rob Beardsley. How are you today?
I'm good. It's great to be back in the office.
Are you feeling jet lagged?
No, no, I'm jumping right back into the New York hustle.
I love that. Well, it's a very really relaxing city, so it's nice that you're full gear and ready to take on the world as per usual. Quick agenda to go over right now. We have a very interesting skin in the game article, which was interesting because a couple episodes ago, Rob and I did in fact unpack that. Then we want to sift through the Pensford report. For those who do not listen to or read the Pensford report, I think that's the one piece of reading and curriculum that you basically shove down everyone's throat, if you will, to make sure that you read and be up to date on. So you wanted to go through the Pensford report, and then what are creative ways to get a deal done in today's environment? So Rob posted a really interesting reel on LinkedIn just about assumable loans. We'll play a little clip of that if the audio will let us. How to get a deal over the finish line with rates being so volatile, and then some personal updates, some Euro takeaways. Obviously, Rob was gone for about 10 days there. So some revelations. It's funny when you leave home and are in that environment where you can kind of process and take in a lot. It's always nice to get some mental resets and maybe some new perspectives and clarity. And I believe you went to two new places that you'd never experienced or traveled to before. So anytime you're in a new, fresh, and stimulating environment, taking in all the sights, smells, tastes, your brain develops and your brain shifts. So be curious to know if you had any of those interesting takeaways to hear. So without further ado, why don't we share screens, excuse me, and go into the skin in the game article. So this is something that Rob and I preach and talk about a lot. How there's a lot of people that maybe do not express or claim to put more money into the deal than what they actually do, and it's a very interesting game to be played because as a newer sponsor like ourselves, putting in 10% of a deal or 20% of a deal is just not frankly realistic. Unfortunately, we would like to invest more. It'd be great if we could, but there's only so much capital to go around, and we do have overhead. The office doesn't pay for itself. You have payroll, you have other things going on, and then also there's earnest money deposits out all the time to keep deals flowing. So, but without further ado, I'll let you dive into kind of this article and how it landed for you, and maybe some of the validation you might have felt when you saw this.
Yeah, so this is another article on the real estate crowdfunding review, which is run by Ian Ippolito. He's a really savvy investor. He was actually the person that wrote the article that we talked about a few episodes ago, talking about the Nightingale debacle with the properties that went bust and were potentially fraudulent deals on Crowd Street. So we unpacked that article and had some very interesting takeaways. And one of those takeaways was the skin in the game or lack thereof, and kind of the mirage or the game that is played when it comes to skin in the game. So skin in the game, as you mentioned, is the term that people use in our industry to talk about sponsors, which are the managers of investments like ourselves, putting in investor dollars alongside their investors. And naturally, that is a great alignment of interests because investors feel comfortable going into a deal that they know that the sponsor is investing in themselves. So skin in the game is a valid way to go as far as making an investor comfortable. But like you said, it's not so simple and it's not so easy. It's not, as a sponsor, if we're running a business, which is to acquire multiple deals per year, we're always doing new deals. It's not realistic for us to be putting in millions of dollars into all these deals, one after another, year after year, right? The money that is made on acquisition fees and asset management fees, like you said, need to be utilized to keep the lights on, and as well as be used for pursuit costs. So when we want to pursue a new deal, we need to put, let's say, a $500,000 earnest money deposit, and that we are risking losing that as well. And then we have other pursuit costs that go towards closing a deal. And then when the deal closes, then those funds can be refunded, and then we can utilize those funds to pursue new opportunities. So as a sponsor, it's really valuable to be liquid for those reasons. And it's also really valuable for a sponsor to be liquid for the purposes of dealing with issues, right? Deals aren't perfect. And all else being equal, as an investor, you would prefer to be investing with a sponsor who has $1 million in the bank rather than nothing in the bank. Because if a sponsor has $1 million in the bank, they're more likely going to be willing and able to fund some potential shortfalls or be able to provide extra capital to a deal that needs it rather than going out to their investors and making a capital call, right? Capital calls are a whole other subject, which we've talked about on the show. And it's best for all parties to avoid them, right? They're bad for a sponsor's reputation. And as an LP on the receiving end of a capital call, you don't want to put good money after bad, because frankly, most of the time when a capital call is issued, that is the case. Not always, but it's never fun because it's an indication of an underperforming property. So everyone wants to avoid that. And so those are kind of some of the hurdles or negatives associated with skin in the game, right? So like you said, while we'd love to just put all our money into every deal and get rich with our investors, it's not so easy, not so realistic. So we have to be honest with ourselves and with our investors about how much capital we're putting into deals. But let's dive into the article. So Ian here talks a lot about, he kind of exposes, as he calls it, a dirty secret, a dirty little secret in our industry, which is that people lie about the skin in the game, right? They say, oh yeah, we're putting in $1 million, no big deal. And, maybe that money is actually put into the deal, but where did it come from? Maybe it's actually not the sponsor's capital. Maybe it's their friend who's an investor and they're putting it in and they're just saying that that's their investment, right?
Or
At
it
the end
could
of the,
be like a rich uncle or a rich cousin who throws $1 million in, but it's family money, but they share their last name. So there's kind of some blurred lines there, perhaps as well.
Yeah, and I would say that family investing in a deal is a good sign. It is a form of skin in the game, but it's not sponsor skin in the game. So there's lots of different ways to play the game and kind of manipulate that situation. One other thing the article talks about is the counter argument to the counter argument about the fact that a sponsor is compensated via a promote. And a promote is a carried interest above a preferred return. So investors earn a minimum return and then sponsors participate in the upside thereafter. So basically the typical thing is, as you can see here in the quotes, a sponsor says, I only get paid well if you do well, right? Because you as an investor get the preferred return and then we share the profits thereafter. And what this article points out is the reality is this sort of compensation structure can incentivize sponsors to take on more risk, because as this chart shows, as the returns increase for a deal, sponsors promote increases non-linearly, right? So the LP's return goes from a 6% return, 8, 10, 12, it just increases. But the promote, as the deal does better, the promote gets exponentially higher, because that's just how the math works. And also, there also could be secondary tiers. For example, in our deals, we have a structure where above a 15% IRR, which means after investors have earned a 15% internal rate of return over the course of the deal, the split on the remaining distributions is 50-50. That's extremely lucrative for us if we're able to actually deliver on returns that are in excess of 15%. And that's one of the reasons why you see this exponential manager compensation. So with that in mind, a manager is incentivized to take on more risk to try to deliver 20% returns so they can make more money in the process rather than just trying to hit a single and a double, right? But we all know the problem with swinging for the fences, right? You can strike out. And at Lone Star Capital, we're much more about doubles than we are home runs, because we want to be able to sleep well at night and we want to have a long-term sustaining successful investment. So some other things in the article, it points out literally this scandal here, looking at skin in the game, right? Kind of industry, I don't know about standard, but the benchmark for a good and acceptable skin in the game amount is 5 to 10%. And
That's
also,
interesting. That's very interesting because let's talk about, let's say, and that's equity, correct? Is that equity or total, the whole purchase price?
So that would be on the equity. So let's say you're buying a $20 million deal, which in today's market is $10 million of equity.
So you're putting 500,000 in.
Yes.
So it's an interesting thing because we're raising for a deal right now that is basically going to require $40 million of equity. So you're basically meaning to tell me that we're on the hook to have to put in anywhere between two to
Two to
four million
four.
dollars. Yes, yes. So that's what this is implying. I mean, obviously we want to put money in it, and we believe in our deals, as you frequently say. We eat what we cook. But at the same time, there's limitations, and it's not realistic. Like, we want to play and do big deals that make sense, and we're not doing any deals just to do deals. We're never going to put a square peg in a round hole just to force it. And we'll dive into that a lot more coming up in the next month or so, I hope. But there's just limitations that we all kind of have, especially as a relatively newer sponsor, 5 years young, makes that a challenging thing, especially when we've got millions of dollars right now currently of earnest money being placed around through various deals in multiple markets.
That's exactly right. Yeah. So talking about deal size kind of helps highlight the difficulties of this matter, right? Investing 10% of the equity on a deal where it's $40 million of equity, that's out of reach for the vast majority of sponsors. And what I also tell people is, if I did have $4 million sitting in my bank account right now, which unfortunately I don't, but maybe one day, I still wouldn't put it all into one deal. That would be very irresponsible of me, right? So the level of wealth that a sponsor would have to be at in order to satisfy this desire is unbelievable. And the conundrum, or the confounding issue here, is that as humans, as entrepreneurs, as sponsors, we are ambitious people. And so what I always say is, the deal sizes are always bigger than your wallet, right? As a sponsor, you're always seeking to do bigger and bigger deals. So
Eyes are bigger than the stomach.
yes. So that doesn't mean to say you bite off more than you can chew, but it means to say that if a sponsor were at the level of wealth where they did have millions and millions of dollars in their bank account, such that they could invest $1 to $4 million per deal and do so routinely for 5 to 10 deals per year. I mean, we're talking about someone with a net worth of $250 million, right?
Well, and it's so silly to think about the premise as you just hit on. It's like, okay, well, if this sponsor, we have 13 deals currently. We've got about $350 million of assets under management, and that's going to be growing. We'll hopefully hit over 450 as the year concludes. But you need to tell me, if we've got about 40% leverage on that, you've got that many millions of dollars working around. Logically, how does anyone actually think that's realistic? I'm genuinely curious.
Exactly. It's just, it doesn't, the math doesn't add up. Because even if, let's just say, let's not say if, let's say when I become that wealthy, where I have the millions and millions and millions, I'm not going to want to do a deal that requires $40 million of equity. That's going to be small potatoes for me then. I'm going to want to do a deal that needs $400 million of equity, right? And so 10%, 10% of the equity on that deal is 40 million.
Yeah.
So the math should never work. It's so unrealistic. It is a dream, and I get that investors like to dream, but it makes sense because it's too idealistic, is what I think I'm getting at, and the math doesn't add up. So it's
Well,
maybe
moreover, it's not logical. It's not realistic, but it almost feels a little bit righteous for someone to think that way. And it's like, how rich do you think every single operator is? Like, it just doesn't compute. Like we don't have expenses or other thing going on, or personal life, or things we want to achieve just outside of business. I mean, frankly, we are people too. We like having fun. You like going to Europe. I like going to Europe. You like wearing nice watches. We also love to invest. Okay. It's just very silly and almost frustrating, because we do get in these conversations very frequently with equity partners who will maybe walk away from us because we don't have enough skin in the game. But, I guess my question to that would be, now that we're really workshopping this, is, well, how many deals a year could we actually do if we upheld that, amount, right? Like 2, 3? And how small would they be, and how slow would it take for us to get to our personal goals that we want to achieve?
Yeah. It would be a very big brake pedal or dampener on our scalability. So I think what you're getting at and what this article is getting at is this dirty little secret of the industry. Because like you just mentioned, we're having multiple conversations. We have frequent conversations with existing and new potential equity partners. And they might say, yeah, if you're not investing 10% of the equity, we're not doing the deal with you. Sorry, right? Not everybody's that rigid. Some people are much more realistic. Some people don't care. Some people are more understanding. But the thing that I truly believe is that it is a little bit of a dirty secret of the industry, and that these investors that are rigid in this regard, and they have more of a bureaucratic process, and they have an investment committee to answer to. Here's my belief. I do believe that they want to be lied to, and
Hmm.
that's a little damning. And I
Let
hope,
me see it one more time for the folks at home. They want to be lied to. Now, how do people pull this off? How does that get done? And it's so funny because as a firm, excuse me, as a firm and a sponsor, not that, as a firm and a sponsor, we are incredibly transparent and I think just brutally honest. It makes me sleep better at night knowing that we're always telling the truth and we're on the same page because the truth will always set you free. But how do some people go through it? And we've had some heated discussions before with people actually that where we've gone back and forth where people are being difficult and maybe they're just saying it because they don't want to outright say no to us right away because we are younger and they want to see it and they use it as a cop out. And right now a lot of people are pencils down unless you've got XYZ and moving the goalposts on the requirements to work with a firm like us who is under a certain maybe 5,000 units or under certain assets under management or under a certain amount of deals that have turned over, right? So, I mean, how is that process done? How are people skinning that cat?
yeah. So just to clarify what they want to be lied to means, right? Basically, the investor goes, "Hey, you're putting in 10% of the equity, right?" Wink, wink. And the sponsor goes, "Yeah, I'm putting in 10% of the equity." Wink, wink. And they go, "Great. Now, with that information, I'm going to go to my investment committee and I'm going to pitch this deal. And I'm going to say, this is a great sponsor. They have skin in the game. We believe in the market. It's a unique deal. They found it off market. I recommend that we invest." And the investment committee goes, "Yeah, this checks all our boxes. We're going to improve this investment." So there you have it, right? That's the kind of that's what it is. And now the question is, how do you pull it off? I think it just depends on how complicit in the lie the equity wants to be, right? If they want to do no due diligence, that's their prerogative, and they can just basically say, "Oh, you're putting in 10% of the equity? Okay, great." And then they don't care, right? And then a joint venture entity is set up, and the LP puts in 90% of the equity for the joint venture, and the sponsor puts in 10% of the equity for the joint venture. And that equity could come from the sponsor, it could come from their friend, their investors, their family, whatever, right? And for many LPs, that's good enough, right? They don't care where the money's coming from. They just know that they're putting in 90% and the sponsor's putting in 10%. And that's good enough for them.
Well, and think about this on the $40 million raise we're doing right now. Let's say if there was a 90-10 partner who came up with 39 or 36 million, we can raise $4 million through our friends and family and private network, no problem. So would that count as, sponsor skin in the game, technically? I mean, there's kind of gray areas there. It's our reputation, our name associated with those people whom are repeat investors. And frankly, a lot of our clients do feel like family, and a lot of our clients are family or are, related, right? And there's many deep relationships. It's really cool that in this world, lines do get blurred from clients to friendships and all between. And, we're really grateful to have that personal aspect and the family feeling business associated with the Lone Star brand and firm. But would some people consider, as we call it, our private network, our friends and family, our retail capital, is that considered part of that 10% tranche?
Yeah, like I said, for some groups that's fine and they don't care. We've worked with groups in the past that's the case, and that's fantastic. And they're much more realistic about how much money is actually coming out of our pocket, right? And then there's other groups that say, yes, you need to put in 5-10% of the equity, and it can't come from your investors. It has to come from true family or you, right? And then finally, the most strict is no, it needs to come directly from your pocket. And so
I wish I was a Rothschild because it'd be so much easier if we could just print all this money and have it go here and go there. It'd be so much easier if we were that wealthy, right?
Yeah, life would be easier with $1 billion, right?
Yes.
Okay, so instead of us being jealous of rich people, let's move on to the next topic of conversation.
Well, actually, I had a question on this real quick. Prior to switching gears, it dawned on me that as we go full cycle and as we crush the projected numbers associated with the deal, what happens for a firm like us is that, yes, we have acquisition fees, we have asset management fees, we have property management fees. Property management fee, we're not making any money on. Sorry, it's zilch. Maybe it's enough to take some dinner. Our clients have to reserve cut, but that's about it. Not even exactly, because we run up big tabs there, of course, in the FIDI. But as we turn over more, as we do turn over more, these deals will hit the promote. The promote is where the waterfall structure hits, and we start making equity on these deals. So my question is, after deals go full cycle and turnover starts occurring, do you think we'll start putting more money in our deals? My natural thought would be yes. We would probably 1031 exchange our equity into more deals, which might be able to help us accommodate that or get us closer to that threshold of maybe 5 to 10%. Would you say it's a fair assessment, or do you think as a sponsor it still doesn't make as much sense to roll that gain over? How does that make sense for you on the more principal side of things?
Yeah, so that's exactly right. As a sponsor matures and has more exits, they're going to be more so. Well, firstly, there's just more money to invest because if you have exits, that's where you make all your money. Not all your money, but you make the big money as a sponsor on the exit, assuming that you perform well, right? And then the other big factor is 1031 exchanges. Like you mentioned, if we, let's say, buy a deal for 40 million and then 5 years down the road sell it for 60 million, and let's say we earn a $2 million promote from that exit, and then we sold that $60 million property, and then we're going to 1031 exchange into a $80 million property, right? And that $80 million property is going to need $35-40 million of equity, and we'll roll our $2 million of promote. It'll turn from promote, and through the 1031 exchange, it'll turn into LP capital as skin in the game, right? So, and let's just say another 5 years down the road, that property is sold, and that $2 million that was promote that turned into LP capital, it doubled, and now it's 4 million, and we earn a promote. And so now let's just say that sale nets in total from the LP and the promote 8 million, and now you're investing 8 million. So in 10-20 years from now, the co-invest should be much more material because of the 1031 exchange rollover, right? And as a sponsor, why are you now co-investing more? Why does it become realistic? Well, like I said, number one, because you now have the money, right? You've got big funds from big payouts from the promote. And number two, you're playing the tax deferral game through the 1031 exchange, right? Because as a sponsor, if you were to say, no, I don't want to 1031 exchange my promote, I'll just take my promote in cash, thank you very much. Well, now you're going to have a tax burden. So it's killing two birds with one stone. You're investing your capital, which is fantastic, and you're avoiding the tax burden associated with the exit. So that is definitely a very good point, and something that all sponsors, I believe, should be aspiring to get to that place.
Awesome. Well, I just want to clarify that and also show there is light at the end of the tunnel and that we do want to put more money into deals. We do want to make that happen. It's just not all the time the most realistic, depending upon where you're at. And that also kind of feeds into why a lot of groups definitely do prefer to have more mature folks who have gone more full cycle because they likely have more skin in the game. And we understand, we understand people's perspective. If you're more on the equity check writing side, which hopefully there's a lot of big equity check writers that do tune into the show. We want to put in, we'd like to put in every single dollar, right? We would love that. But there are just constraints for groups like yourself who are ambitious, who have millions of dollars out at any given time that may not get returned or could get lost if things change. So there's a balance to everything. There's two sides to the coin, but I just wanted to kind of clarify that. Now let's transition into the Pensford report, which you can definitely dissect this better than myself, but I thought there's a lot of interesting nuggets that was kind of baked into this one. from the author, who, by the way, is a Eagles and Penn State fanatic. If you read the Pennsford enough, you will be very up to date with what's going on with all Philadelphia sports at large.
I'm going to share my
You might
screen here.
perfect.
So this is the Pensford letter from Monday, which was the 27th, or no, the 28th. So we're going to be sharing this with people a little bit late, but basically this is talking exactly about what I was saying back when I was in Poland when we recorded last week, which is that I think that inflation is a bit overstated right now, and that very soon we're going to be talking about deflation. Something that in this article that I learned, and it's from a Penn State uh, economist or something, a professor or something. Here's where it is. So they've been talking about this lag of the impact of housing costs in the CPI and PCE reporting, right? And when the economy is on the up, inflation is underreported. And then when it's on the decline, it's overreported. So let me just try to find where they talk about this.
So it's interesting that there's a lag on one end of the spectrum and then an overhype and snafu, if you will, on the other side of it, right? So, and that's also kind of a metaphor to life. People like to really focus on the negative as opposed to the positive.
Yeah, well, it's a lagging effect and everything balances out in the long term, right? But things get out of whack, right? The stock market gets really overvalued and then you have a crash and then it gets really undervalued and all that. So same thing to a lesser extent in the economy.
Would you mind what you highlight just for the audience who's not watching, but maybe reading the excerpt if you are highlighting, please?
Yeah, I'm going to read a bit of this article. So the puzzle is that official, in quotes, inflation rates did not respond to monetary policy. This is back in 2010 when we were trying to stimulate out of the great financial, the GFC. So did not respond to monetary policy as many policymakers expected, despite its unprecedented scale. So what does that mean? We printed a ton of money. We dropped interest rates to zero. Shouldn't that cause inflation? Where was the inflation, right? However, we show that inflation rates based on the alternative housing rent measure did exhibit the expected response to the change in monetary policy. In particular, the modified core PCE inflation rate exceeded the 2% threshold in 2011 and has been consistently higher since then. So what does that mean? It means that yes, the inflation readings are low, but when you factor in the rises in rent and housing costs, home prices, inflation is actually kind of high. In addition to, due to a very rapid and constant increase in housing rent since 2010, the modified inflation rates were significantly higher than the traditional rates. In fact, the NRI core CPI indicates that annual inflation rates were constantly higher than 5%. So that's a pretty crazy number because 5% is an alarmingly high inflation rate. So basically, the argument is, let's just pick out housing in particular, as housing is on the rise, inflation is underreported. But right now, as we know, housing is not on the rise, it's on the decline. Rents on average in the last 12 months are down slightly, and housing prices are down slightly. So inflation is actually overrepresented. So inflation's at about 2% right now, and it's overrepresented. So the reality is, as I mentioned on last week's show, we really do not have an inflation problem in this country right now.
Well, and I definitely think, and we've talked about this premise before, but certain areas are always ebbing and flowing and changing. I refer back to this so often because it was so fascinating to me when I was selling homes in the Bay Area, and that was how while all the nation basically experienced a massive housing bubble, the Silicon Valley was the most resilient during that process, I would say. And likely, Manhattan, I don't have intimate experience of tracking it, but I would anticipate that there was a couple of core markets that really transcended the national averages, right? In conjunction to that, I think what we're seeing is there are some areas that are inflating a lot more than others right now, but there's also definitely a pullback going on. And what I found to be really interesting in Houston specifically is how Houston never ran up as crazy as Phoenix did, which is having kind of a pump down right now to earth. And I can't speak to many other markets as well, but I know Nevada is also, Las Vegas is kind of experiencing a downturn. And there's a couple other markets as well that I've heard that are, a little more, fluctuating on the downtrend, but are stabilizing right now. Houston has been really interesting because on an operations perspective, rents have been really strong and we're getting renewable pops without really renovating as much. So some markets will perform better than others. And, this goes back to being in pro-growth areas and doing the homework with, choosing the sponsor to work with and also the sub-markets to invest in. Some areas will experience a little bit more, I guess you could say, inflation and growth than other places, which is just fascinating on a macro level. But when we get micro into the areas that we're looking in, there's a very, very specific reason as to why we want to be in the areas that will experience growth when other areas are staying stagnant or kind of going back down. Houston has, it's the third biggest city now in America. Number one is, or third or fourth, it's New York, Los Angeles,
Chicago, then
Chicago,
Houston.
and then Houston. And I think with trends going the way they are, I think Chicago is going to get popped back down, and Houston will probably creep back up or creep up.
Absolutely. So just to show people who are watching the chart here, so we have blue line, PSU, Penn State marginal rent index. Red line is the traditional PCE rent, and then green line is traditional CPI rent. So to simplify things, green and red are pretty much the same, as you can see in the chart. Green and red are just right on top of each other, and that's the traditional factor that factors into CPI. So when rents and housing is factored into the most reported inflation number, that's the red and green line. And then the blue line is the more volatile and arguably, as put forth here, the more accurate input of housing inflation, deflation as it relates to CPI print, or as it should. So as you can see, number one, it's more volatile. And number two, there's a lag. So we'll take it here, for example, the blue line plunges and then the green and red line follow. And then it spiked and then it came up as well. I mean, visually, I don't see this as exactly 7 months, but what they're saying here is that it's a 7-month lag from this blue line, the more precise one, to what ends up showing up in the inflation print. So basically, it's only a matter of time, exactly 7 months of time before where we are today, which this PSU benchmark is saying minus 4% year over year change is where we're at today. So rents on average, it's saying are minus 4% for housing costs. So we have a negative 4% inflation effect that should be contributing to our inflation numbers. And so that will be felt, that 4%, maybe not full 4% because obviously it's more volatile. Maybe it's negative 1%, right? And that's going to factor itself in, and we're going to have inflation in the ones soon enough. So anyway, this is just some interesting stuff. We like highlighting the Pensford letter because I think it's a good way to get your weekly dose of macroeconomics. And so we wanted to share that with everybody.
Can I ask you I need to give me a yes or no answer. Are we in a recession?
No.
And then I'm going to ask you just point blank yes or no's. And it's an opinion, no gun, metaphorically held to your head. Are we going to go into recession?
Yes.
Now this is an opinion. When and for how long?
Well, I don't know. I'm an optimist, so I don't think it's going to be very long.
I don't think it'll be a deep one at all. Frankly, I think there are a lot of great signs. I think AI and technology will drag us out there. And, I think there are more positive signs. I do think 2024 will be a very choppy and interesting and colorful year.
Yeah, it sure will. It's going to be a short recession. I don't think it'll be deep, like you said. The Fed has many tools at their disposal to re-stimulate the economy, right? Everything is deliberately done here. The Fed has placed a very strong brake on the economy. What are they trying to do? They're trying to slow down the economy so they can slow down inflation, right? And kind of get back to that Goldilocks setup where we have 3% GDP growth and then 2% inflation, right? Which means real growth of 1%. Real growth of 1%, that's amazing. That's what they would like to get to. So we were kind of technically before in somewhat of a recession, kind of coming out of COVID because we had really high inflation. and growth was still doing okay. But when you have higher inflation than growth, right, that's negative growth on a real basis. Real means adjusted for inflation, right? So if we're adjusted for inflation, if inflation's higher than growth, then you're actually losing. So that's why we were in a recession before, and that's why we're not really in one now, in my opinion, because inflation has been subdued down to about 2% today, and we're probably growing right around there as well.
Gotcha. Well, awesome. Thank you for the deep dive into that. Switching gears to the next thing that we want to speak on, which is what are creative ways to get a deal done in today's environment? And then it was assumable loans. So you posted something really interesting to LinkedIn. You're obviously a big individual. We post all the time there, but I thought this video really stood out. And then you actually got a lot of messages. I think you told me that, and then also just generally a lot of comments regarding actually how true your video was. If you want to maybe play it or say out loud kind of the premise of it, that would be useful.
Yeah, sure. I mean, we'll just try playing it and see how that goes for everybody. This time we'll play a little clip. But yeah, like you said, we're posting almost, I think, every day on LinkedIn and having good conversations over there. So we'd love to connect with you over there if you aren't with us over there already. Buyer, assume your existing loan rather than paying it off. That could save you a lot of money on prepayment penalties. So that's an analysis that you need to run. Is it better to sell free and clear? Is it better to sell on assumption? Similarly, another superpower are supplemental loans. So anyway, there's the media for the day.
Well, do you want to dive into the nuance of that and the importance maybe of consumable loans as opposed to selling and someone creating new debt right now? Two-pronged, because new debt to acquire right now is very expensive. And then also prepayment penalties similarly can also be really expensive if you depart from a loan early. So can you kind of unpack both sides of the coin there from a buyer and a seller perspective, please?
Yeah, absolutely. So from the buy angle, this is true of any environment right now, or any environment, but right now it's also particularly interesting because rates are a lot higher today than where they were just 2 years ago. So if someone has a loan that they originated 2 years ago at a low rate and they want to sell, you could, rather than putting on a new loan on that deal, you could actually just assume their existing loan, which is accretive to your returns because you're getting a below market interest rate. The problem with that is the seller knows that they're giving you accretive financing and they're going to want to be paid for it. So they're going to be wanting to sell for a higher price, and they're justified in their higher price because you're getting a better return by way of their debt.
You're getting yesteryear's debt.
Exactly. However, as you might have heard me say once or twice before, purchase price is permanent, financing is temporary. So what's going to happen if you overpay for a deal today, but the numbers make sense for now because you assume good debt, but then in 3, 5, whenever, how many years that loan matures, will that turn out to be a good deal then? Because your purchase price is permanent. That's the price you paid. The good financing eventually is going to mature and you're going to have to refi into a new loan at that point, or you're going to have to sell. So at some point, you're going to have to reckon with the capital markets of that time. And nobody knows the future, right? So we don't know where the capital markets are going to be in 3 to 5 years. But that's a risk that you take by quote unquote manufacturing higher returns through a loan assumption with below market rates, right? Inevitably, you're going to pay a higher price than you would if you were to buy the deal free and clear, because the seller would be willing to sell for a lower price if they're selling free and clear to you. So those are some interesting things to factor. And it's not that complicated, right? At the end of the day, you just need to be honest and realistic with your exit cap. And if your exit cap is appropriate, then your underwriting is going to look like this. You're going to get better cash flow because you have the below market interest rate, but then your IRR should be okay, if not maybe a little bit worse, right? Actually, let's walk through this a bit because I think this is an interesting mathematical concept. So if you're going to overpay us a little bit, but then get below market debt, you're still going to be able to manufacture stronger cash flows than you otherwise could. However, because you overpaid, you're not going to make as much money on the sale, which is going to reduce your IRR, right? Because the sale is how, let's face it, a big part of your IRR. So that's kind of the dynamics there. If you were to buy free and clear, well, then you're just going to kind of get the market rate IRR, market rate cash flow. What's interesting about this concept is for a long time, it was the reverse. Back in 2016, 2017, 2018, we had higher rates than 2019, 2020, and 21. So during that period of time, if we were looking at deals that were loan assumptions, it was most often a loan assumption at a higher interest rate than the market rate. And so that would mean that we would get worse cash flows if we were to assume the loan. All right. And so you would say, well, why in the world would you assume the existing loan if it has a higher than market interest rate? Well, the answer is, as you alluded to, prepayment penalties. And guess what? Prepayment penalties, if they're yield maintenance or defeasance, are even more expensive if the interest rate on the loan is above the interest rate of the market, because the lender, it's how they protect themselves. They don't want you to pay off that loan because it's above market. They prefer to be getting paid 5% rather than you pay them off and then the prevailing rate in the market is 4%. So the prepayment penalties even more expensive, which is why as a buyer, you might want to assume that loan because the seller will take a discount. So it's the opposite dynamic. When you assume a loan at a above market interest rate, you'll actually get in for a better price, but you're going to have to suffer with worse cash flows. And then hopefully in the back end, you make up for those worse cash flows through a higher sale and a better IRR.
Wow, that was very dense. That's
Sorry.
awesome. No, no, that was incredible. That was like a very, very well thought out and well put together and really comprehensive. So I guess some softball questions to you. I mean, how does a deal make sense right now to sell it or to sell with an assumable loan? I mean, what creates a perfect storm for a buyer to go in to want to do that? And similarly, how does a seller want to do that? And then also, if there is an assumable loan, can you 1031 exchange from that assumable loan into the next deal? What does that look like? Is it kind of like a mortgage wrap?
Yeah, fantastic questions. So as far as what makes an existing loan more attractive to assume, right? So if you're sitting here as an owner and you're thinking about, okay, is my loan attractive for someone to assume? Should I refi into a new loan right now? And how is that new loan going to be potentially assumed down the road? There's two big factors, or maybe three, and we can kind of connect them all. Number one is leverage, but leverage is what it is. So there's not much you can do about that. Rate is also a big factor. And again, there's only so much you can do about that. And then finally, there's interest only. And there is something you can do about that, right? You can structure your debt with more or less interest only, depending on what you want to do. So the reason why interest only is so important is because let's say I financed a deal 2 years ago and now I want to sell on assumption and it's a 10-year loan. That means there's 8 years of term remaining on the loan. If I, let's say, got zero interest only, meaning I started amortizing 2 years ago and I've already amortized the loan down for 2 years, and a new buyer is going to assume that loan, the debt constant is going to be rather high, and that's not going to be very attractive for a buyer because they're going to have just weaker cash flow. And a lot of buyers are cash flow sensitive, right? As you and I are well aware, investors like cash flow. So if instead you would have structured that 10-year loan with 10 years of interest only, well, that's fantastic because a new buyer can come in and assume that loan. It's not paid down at all. So they're getting the full loan amount and they're getting interest only for the remainder of the term. And that's going to make their numbers look a lot better. And so they're going to be able to afford to pay a higher price. So as an owner today, and you're thinking about your financing, interest only plays a big factor, not only in your cash flow today, but it also factors into your ability to sell an assumption later. So those are important things to consider. Also, to address your 1031 question, it's a very simple answer. It really has nothing to do with 1031s. You can 1031 into a deal with a loan assumption. You can 1031 out of that deal. It doesn't really add any constraints.
Okay, gotcha. So now that you kind of broke that out, I think the perfect storm would be someone who maybe put 10-year agency debt on a deal, if they can make that happen, and call it 2021 if we're really reliving idealistic. Maybe did their business plan, did everything, and then look, we're looking to sell right now where you have about a 7 to 8 year tarmac left on that departure where, hey, we're getting incredibly attractive debt here. We know that we have a 7-year window to exit from the property. Would that be a circumstance? Because it would still scare me a little bit too much to pay the premium, as you alluded to, if someone put like a 5-year debt note on it or a 7-year and call it 2020, maybe even 2020 or 2019, 2018. That's just a little bit too thin for me to feel comfortable paying a premium, knowing that the exit is on its way on that end. Would you say that's a fair kind of assumption if you were, I guess, a prospective sponsor looking at an acquisition?
Yeah. So there's two really interesting points off that point. So firstly is your point of, okay, well, if somebody got a super great loan, let's say a 2.75% loan back in 2021 or whenever loans were just insane, right? And they implemented their business plan, everything's great, they created value and they want to sell now. Even though prices are down like 20%, let's say.
That paper is so valuable at that price right there. So it's like, shoot, like it makes it tough your cost per door because you don't have to think about, yesterday's or today's debt when you've got today's rents associated, right?
It's such an asset. That really attractive debt is such an asset that even though prices are down 20% today, you could probably sell for almost peak prices, right? Not quite, but almost peak prices, which is crazy, right? You're really, really hitting a home run there. Now, the buyer of that deal it's a question. Are they buying the right deal? Because they're paying, let's say, 15% above market value. That's what they would pay. So they have to ask themselves the question, is it worth it to pay 15% above market value such that I can get this accretive financing? And what they're banking on is that in 5 years' time, when they go to sell, cap rates will have compressed and they'll be able to sell at a profit. So they're basically banking on being able to, here's the market today. They're going to pay 15% above the market. And in 5 years' time, the market's going to be here. So the market's going to have to catch up to that 15% overpay and go higher so that they can make their profit. So that's a risk. Going back to your other point of, well, let's say the deal was financed in
2018.
2018 and
10 year, yeah, and 7 years on it. So we got, call it,
it matures in 2 years.
yeah.
That's a really tricky scenario. Not a lot of people are assuming debt in that window
It's
for
basically a
obvious
bridge.
reasons.
Yeah. For our purposes, well, that's a bridge debt, and you might as well buy on bridge than a 2 year short note like that. Would you agree?
Well, no, I actually don't agree
Okay.
because so here's where assuming short-term debt could be very interesting. If you have a deal, this is actually the home run deal when it comes to assuming medium-term debt or that debt
Let's
where there's
manifest the perfect storm here. Let's go.
we're
Yeah.
manifesting. So let's say somebody did finance a deal in 2018 or something like that, right? And today's 2023, and let's say there's 3 years, 4 years remaining on the debt. Let's say 4 years remaining on the debt. Now, let's just say the perfect storm is they finance it with agency, so it's a stable deal. But let's say they mismanage the property. So now the property has deferred maintenance, the property has high vacancy. Rather than going and buying that deal with a bridge loan, you can go ahead and assume that existing loan. So now you're able to buy a destabilized deal, but you're able to have permanent financing on it at a lower rate, at a lower risk, lower leverage. And then you don't have, and it's a perfect window because by the time you go in there, clean house, implement your business plan, and look to sell in 3 years, there's a year left on the debt. You're going to have a very modest prepayment penalty and you're out. So you're able to actually underwrite a 3-year hold, which will maximize your returns, right? It's a realistic 3-year
No
hold.
one is underwriting a 3 year hold right now.
Yeah.
Very few, I should say, are very few. So awesome and great nuance to it. This is a topical thing that people are going to get into. So hopefully, maybe if you are on the sponsor side, this might help you avoid some mistakes. And if you're looking to sell, well, maybe this is a creative way to get out of a circumstance if you are looking to part ways from a property, but you're struggling with solutions to make things make sense for all parties associated with the deal. So hopefully you got a nugget or two out of that and can think about something for the future as it pertains to that. Any other notes you want to go on through the assumption world and maybe creative world?
I think that was a pretty good discussion. We can maybe save some other tricks up our sleeve for another time.
Exactly. Or, maybe you can pay us for consulting for all these nuggets we're dropping on you today. With that said, switching gears, how to get a deal over the finish line with rates being so volatile. So there's certainly a lot of choppiness in the waters due to treasuries and debt being, challenging and, sellers not necessarily needing to sell just yet, extend and pretend, as we've said several times in the show. But, in your opinion, how do you get a deal over the finish line right now? It's been challenging for everyone associated, for lenders. Lenders are frustrated because, that you could quote someone someday and then you're the bad guy when rates go up, when it's not like they're Jerome Powell. And then there's scenarios for us where, we want to provide, great returns to our investors, but if we project here and it ends up being here, our numbers get chopped down and things become thinner, and that's no fun to tell an investor that, hey, yeah, while we locked up this deal, your IRR has been crimped and compressed a bit, so that's no fun. So kind of walk us through what needs to get done. And I think there's just basically three solutions, unfortunately, or three answers, but I'll let you dive into them.
Yeah, there's no elegant solution, right? Something has to give. And so if you put a deal under contract and rates move up materially higher on you, which really negatively impacts your projected returns, it means that you need to do a couple things. Number one, the simplest one is you need to ask the seller for a price reduction, right? So it's very simple math. If you originally projected a 15% return, but then rates moved higher, which then reduced your loan sizing, so your loan proceeds went down, now you have to raise more equity, that dilutes your returns, the interest rate is higher, so the cash flows are lower, all those things negatively impact the deal. Well, you go back to the seller and you say, hey, for me to get back to my originally projected 15% return, I need a price reduction of X.
That is called, in the broker world, a retrade. It is something we would never do, right? Yeah, but it's something that's really sucks for everyone. Everyone would like to buy a deal where it's here, and everything's fine and flat, and there's no changing up. But in a choppy environment, that's just one of the things that starts to happen, and it sucks for everyone. It sucks for the sellers and the investors who thought they might get a certain price on the exit of the deal, and then it sucks for the buyer because, as a buyer, we don't want to be known, or any buyers want to be known as just a chronic retrader, but sometimes things change in the escrow process and makes it tough.
It does. And so retrading is a touchy subject, right? That's a no word in our industry. Brokers don't like people to retrade because brokers want a simple transaction. They want their seller to be happy. They want their buyer to be happy, and they want to earn their commission. And
commission without chopping any of it up. And they probably like to throw their lenders a deal as well.
Of course. And so retrading is perceived as negative in the industry, and brokers kind of leverage it as a threat, almost like, hey, if you retrade, you're going to get a reputation for retrading, and then we're not going to award you future deals. So brokers are very, very important in our business. They are gatekeepers to a lot. And so it is really important to maintain a strong reputation in the community. With that being said, brokers aren't dumb. They're very smart. They know the market extremely well. So everything that we've talked about on this show, they know in and out. So they know that rates affect the deal. They know how the market's changing. They know more than anyone. So they get it.
They also are, in just like, they're their cooler talks, the water cooler talks where, oh yeah, this deal got beaten up. Hey, I got 4 offers on this. Hey, I got nothing on this. Hey, this product or asset class is struggling. Hey, yeah, no one is touching this neighborhood with a 10-foot pole. So they know everything very well. That's their job, is their knowledge and information and navigating through it for people like us. But they know 3 steps ahead and 2 months ahead what's going to go on, probably, and they can probably forecast what's going on as well. They know these conversations are probably coming when they're working with the buyer and the seller, and certain words to navigate it. And then it's all, of course, just a bluff. Is the buyer actually willing to walk away? Do they have skin in the game, or how much skin in the game? Do they have a lot of, earnestness associated? It becomes very challenging, and sometimes these real estate deals are big games of poker.
Yeah, that is true. Well, I think on a kind of a brighter note, or to build on this point that brokers are smart and understanding, I don't think they always view every price reduction as a retrade. I think what a true retrade is when a buyer goes back to the seller after they've put the deal under contract, after they've tied them up for 30 days, done their due diligence, and then they go to the seller and for really no reason at all, no legitimate reason, they just say, "Hey, I need a price reduction." And they come up with some bogus reasons just because they feel like they have leverage over the seller, right? That's a true retrade. But if it's just something happened that is outside of either the buyer and outside of the buyer and seller's control, then that is a fair price reduction, in my humble opinion. So anyway, with all that being said, disclaimer, we would never retrade. We always close. We're perfect buyers, right? Said every single buyer ever, right? Everyone's a great buyer. Everyone always closes and nobody ever retrades, right?
It's the first time, I swear. Yeah.
Yeah. No, it's never happened. But in reality, we're gonna have some interesting topics of conversation to discuss in future episodes that dive into this on a much deeper level, on a much more personal level, and a much more expensive level. So we're looking forward to
The
sharing that with
popcorn,
everybody.
yeah, the popcorn will need to be popped. The liquor will need to be poured if that's what you're into, or the Diet Cokes if you're me, and all that jazz. I guess any other creative ways to get a deal done in this market. I suppose, or with volatility. I guess it's just assumptions, perhaps, retrading if the debt kind of moves on you. Anything else you can kind of mention, or any tips and tricks and nuggets you can share with the people, the
Yeah,
good
yeah. So
listeners of Capital Spotlight podcast?
so to round it up, right, we've got the price reduction, and then the more malicious one would be just to jam the deal down your investors' throats, right? This is not a nice thing to do and not something, in all seriousness, something that we would do, right? Obviously, we take our reputation with our investors very seriously, and we're not just going to do a deal for the sake of it. Like you said, we're not going to put a square peg into a round hole. So, but that's the reality. You could just, oh, our interest rate's gone up. All right, well, we'll fudge the numbers over here and over there to kind of make up for it, and we'll end up at the same return projections. Investors are none the wiser, and let's get the deal done. Let's collect our acquisition fee, right? So that's another option as a sponsor. And then I feel like before we recorded, we had a third option, but I don't remember what it was. Oh, yeah, I remember. As a sponsor, you could cut your fees, you could cut your promote, which then gives more return to investors and could potentially make up for the rate change. I really don't like that because I'm a sponsor and I don't want to give up my fees and promote. And also, it's taking from a small pocket and giving it to a big pocket. And what does that mean? Well, that means if you're going to slash, as a sponsor, if you're going to slash your promote and take away a big chunk of your compensation just to give your investors a little bit more return, it really just doesn't make a ton of sense, right? You can dramatically cut your comp as a sponsor, which is very painful to you. And all that's going to do is pop the returns for investors by 70 bips, right? So as an example, that could take it from a 15% return to a 15.7% IRR. So it's like, that's kind of a not a very elegant solution, in my opinion. It's painful.
Well, so we don't want to be known as a discount sponsor. Yeah,
You
we're
also don't want to do that.
yeah, and it's hard to let the cat out of the bag there. And a lot of times people ask, "Well, yeah, I'll invest with you if you give me, Class B shares for 100K." It's like, no, because there's people that invest with us all the time that don't demand anything that we should do that for. You're not saying we're gonna do this, but people who invest, there's a couple of investors who give us $250,000 legitimately every single deal, and we barely even have to go through any of the underwriting with them or anything at all. They see it, they know it's from us. That would be the person we'd rather, give maybe perhaps a deal to, as opposed to a one-time investor who's making demands and threats, who thinks they can strong arm us because, their $100,000 will make or break our acquisition. So, interesting.
Yeah, so that's pretty much the conversation here. However, to add something interesting, I had this thought the other day. It's just as volatile as treasuries have been, it's just so brutal. Putting a deal under contract right now is incredibly nerve-wracking, and it's in particular nerve-wracking as a sponsor for all the reasons that we just discussed. And so what I found interesting is when it comes to fixed rate debt, sponsors are actually taking a ton of risk because you don't lock your fixed rate until right before closing. So you put the deal under contract, and then 60 to 90 days later, you actually lock the interest rate and then close. Well, that interest rate could materially change. The whole world could change in that 60 to 90 days. And as a sponsor, you're on the hook. So fixed rates are actually risky for sponsors, but then once you close, they're very stable for investors.
And I want to make this abundantly clear to everyone who will potentially wants to raise money for us, who wants to, work with us as, a fund manager, a JV equity check partner, and, any, investor, LP investor. You take 0% risk in the deal prior to closing of escrow on the acquisition. Let me say that one more time. You take 0% risk associated with any deal prior to the close of escrow. Obviously, every investment has risk once it has closed and the business plan is running through, meaning us as a firm have to shell out all the money, take the reputational risk, go through the process. More than anything else, one thing you can't get back. You can get money back, but you cannot get back time. And it takes a lifetime to build a reputation and a moment to ruin it. So the whole world is working against you. There could be another war in Europe starting. There could be an oil crisis that pops up. There could be this or that. A meteor could hit, and we're really screwed. Okay, so we have non-refundable money at times out, and we take on the burden of millions of dollars, or hundreds of thousands of dollars at any time and every time, basically rolling through for deals. So yeah, we're these greedy sponsors, but I think people don't really appreciate the sensitivity. And as I've gone into the business more, it makes me honestly wonder how the heck you can sleep so well at night, you and Kent, just given the amount of capital that's in and out at all times. It is bonkers to me. It truly is. But the amount of risk that is accrued by a sponsor, I don't think is appreciated enough, frankly. And at any moment, you could get refunded. We've refunded people because there was a family emergency. We've refunded people, and that's before closing. We've refunded people who say, hey, I'm actually going to buy a house now. And we refund people because the process of the acquisition took a little too long for their liking, regardless of the fact that their money is probably just as safe doing nothing or sitting as it is in I can make 4% in a yield account. Yeah, I understand that. That is not nothing. But I just think a lot of people should be, or consider, being a little bit empathetic with regards to, and I know this sounds like a sleazy sales pitch from, our side of the table and our end of the hustle, but the world is working against you when a deal is in contract, and especially when there is volatility that we're experiencing right now. So just to put into perspective, it is not an easy game. There is a ton of money and things can shift. And there was times like when the rates were going down that it was very much so in your favor. But right now in the last 12 months, it has not been in any sponsor's favor. And you can't really underwrite or be competitive if you put in, a buffer or a range in debt. It just doesn't work that way. So
Right. Yeah, that's a concept that maybe when we have more time we could cover as well. But thank you for that clarification, just so that people understand that everything that happens pre-closing is not an investor's risk, right? The sponsor, we as the manager of the deal, are taking all the risk up front. And so
we're changing our PPM to explicitly state that, because there was one person that his family member wanted to invest but did not feel comfortable because that wasn't explicitly in there. Now we can say that, and they hadn't worked with us yet. He loves us as a client, and I know we'll convince and make sure that the family kind of comes involved. But there was just some specific language. So I've been really adamant on there on my end, on the sales side. Why would we not just explicitly put that in there if that's an objection I don't need to handle, right? It seems it's useless to not put that piece of literature in there.
Correct. So to finish that, go back to my point about sponsors taking a lot of risk when it's a fixed rate loan, right? Prior to closing, you first put the deal under contract and it's a fixed rate loan, but you're not locked until right before closing. So the sponsor's taking all that risk 60 to 90 days. But then when the deal finally does close, there's the loan is fixed. And so now LPs, the investors in the deal, are taking far less interest rate risk. Now, when it's floating rate debt, it's actually the opposite. When you put the deal under contract and it's floating rate debt, the sponsor's not taking risk before closing, because floating rate debt is not as volatile as fixed rate debt. Floating rate debt is controlled by the Fed, and it's much more accurately predictable for the future. And so you can build that into your forecast. And so pre-closing on a floating rate debt deal, the sponsor's taking no risk or less risk. But then when the deal closes, that's when the risk really kicks off, because guess what? Your loan is floating. And so now investors are taking a big risk because they're subject to fluctuations in their interest rate. So it's interesting, just to kind of really quickly summarize it. Fixed rate, sponsor takes risk before closing, LPs safe after. Floating rate debt, sponsor is safe through closing. Once the deal is closed, investors are at risk. So I thought that was an interesting dichotomy there.
Yeah, it's a nice nuanced and wrinkled point that you just made, and it's just fascinating the different structures, whether it be adjustable rate or variable, whatever it may be, in reference to the debt type. And just once more, and once again, Lone Star will exclusively doing agency debt for the fact that we want to sleep well at night. We want to have certainty on cash flow. And unfortunately, there's some deals that where you fixed or floating rate debt or bridge debt, cash flow is not guaranteed. And also maybe there is cash flow, but you got to, save money to the side to maybe, hold it for a cash and refi so your investor's capital isn't diluted. So many moving parts associated with these deals. It's really fun, but it can work for you or against you sometimes. And right now, if you're an agency player like us, it is not working the most favorable. So there are ways we got to work around it, and we just got to rise up and make it happen. And we look forward to smoother sailing waters. Finally, transitioning into a more personal note, you obviously were in Europe. So maybe tell us about your experience, your trip, the new places that you went to, and all that good stuff.
Sure. So, like we discussed last time, I was in Warsaw, and then I went to Bucharest, met with some good people. I was attending some mastermind events, met some wealthy real estate guys, met some fighters, met all sorts of different people. So it's just always great. We met the coolest 19-year-old that exists on the planet. So that was always very interesting. That was very interesting. It's inspiring and humbling to meet somebody who is 19 and they motivate you and inspire you to make more money, to be cooler, to dress better.
So this guy must be really, as a lot of people say, him. It's probably a more Gen Z phrase for those who don't know it, but he's obviously, him's like the man. It's just the iteration of today's era. If someone gets you impressed and gets you inspired, they must be, really moving and shaking. So what specifically about this individual kind of inspired you?
Well, I mean, just being 19 and being so dialed in from your look, and because it wasn't, it takes time to kind of develop how you carry yourself and how you dress. And I know dress is kind of a simple example, but it's a very overt example, right? You can instantly see how somebody is dressed. And so I'm trying to think, at 19, I wasn't for sure not wearing suits, right? And not as nicely as I carry them today.
When I was 19, I was just trying to go to my fraternity parties and just probably wearing tank tops and Converse and, stuff like that. So,
Right. So
yeah.
that's the hack of mentorship and surrounding yourself with the right people, because it doesn't take you 20 years to develop style. Let's just use that as the example. If you have a mentor who explains to you, hey, you should conduct yourself this way, you should dress professionally this way, boom, 6 months, you can go, and with the money, you can build a nice wardrobe. It also doesn't take it doesn't take thousands and thousands of dollars, might take a couple $1,000s to have kind of the basic starter wardrobe. So anyway, clothes is a good example. But basically him and his business partner are making $1 million a month. And I'm thinking, okay, that's the next level. 19-year-old. Yeah. All right. Let's level up. Let's get back to New York and let's hustle. Let's find a way to scale.
Well, I love it because, being hungry is infectious. Your surroundings, one way or another, will work for you or against you. You are the average of your five friends. That is a theme that we'll say over and over and over again. I've done everything I can recently to really level up my surrounding and make sure that everyone I do give time to and that I let into my life is a positive force in all aspects, spiritually, mentally, financially, you name it, physically. You start moving and shaking like the people that you spend most time around. So it's great that you got that. Hopefully it'll rub off on myself and also the firm as well too. And then you also said something, you texted to me. I think it was just out of the blue. You said self-realization versus self-actualization. So can you please just unpack what your thought process was on that? Because I think it's interesting. And I was trying to wrap my head around that thought, but why don't you unpack that a bit more and what made you compelled to text me that?
So for those that aren't familiar with those concepts, self-realization and self-actualization, they are directly opposed to each other, but they're very important to master both. And so self-realization is realizing who you are, right? And being comfortable with who you are and accepting yourself and being happy with who you are, right? That's really important because you should like who you are and you should be comfortable in your own skin, right? That's contentment, that's happiness, that exudes confidence, and that's a great base to then operate from. However, as you can imagine, right, if you're happy with yourself, why would you improve? I'm just sitting here, I'm happy, I have the money I want, I have the trappings of success, whatever it is that I want. If I have it, then where's my motivation to continue, right? So self-realization is actually a slippery slope. It's a scary thing, right? It's complacency, or it could be misconstrued as such. Now, what is self-actualization? Well, it's becoming what you want to become, right? That's the journey. And that, in my opinion, is the most exciting part of life. And the best part is setting goals and basically deciding I want to get to this end state and I'm going to pursue it and then being able to reach it, right? That is such a magical thing about life. So anyway, self-actualization is that exact concept that I just described, right? It's improving.
Is that kind of like the pursuit of success, the pursuit of happiness, as opposed to self-realization? It's like, hey, my name's Craig McGrother. I'm 29. This is my net worth. This is the car I drive. This is the house that I own. These are my friends. This is what's going on. I'm basically assessing where I am in the ecosystem, in the food chain, if you will, right? And then self-actualization is the pursuit of, hey, when I turn 40, I want to be worth $5 million. I want to be living in Arcadia proper. I want to be driving X car. I want to have this on my wrist, XYZ. Is that kind of what you're alluding to? So it's kind of like manifesting such a overused word these days, but kind of the crescendo of to your life that you're trying to get to, essentially, or hitting your pinnacle.
Yeah, I would boil it down as simply as possible to say it's the balance between being happy with where you are and being happy with who you are versus wanting more, right? They're at odds with each other.
Yeah.
It's a very difficult thing. And so it's hard as you get more success, it's hard to not get complacent, right? Look at the opposite of that, Tom Brady. The reason why Tom Brady, in my opinion, is so inspirational is how did he stay motivated for year after year after he proved that he was the best? He was the GOAT.
You're playing against yourself at that point. Like you have to, it's like Michael Jordan, where it's like you hear him talk. It's like I'm like literally mentally playing games with myself to motivate myself. You're creating false narratives to motivate, and you're just chasing the person in the mirror at the end of the day, no one else. Especially when you're the trailblazer in that regard, and you're at the top. How do you stay at the top? How do you stay disciplined and motivated when you are getting, not fat, but metaphorically fat and happy, right?
Yeah. So it's the reason why this concept hits home for me is because I, quite honestly have had some struggles with complacency because I've set goals and I've achieved them. And then it's kind of like, okay, well, I've kind of got to where I wanted to. And I see the path towards the next goal as relatively or even readily achievable. And it's just kind of putting one foot in front of the other. It's easy to get complacent and just kind of coast. And that is very negative, and that's not what I actually want for myself. And so I need to battle against myself. Although self-realization is very healthy, it's very good to be happy with myself. I need to find ways to motivate myself, like meeting a 19-year-old who's crushing it and making way more money, right? So that is an interesting balance. And so that had me thinking, because I thought, what's kind of the best state of mind? And it's uncomplacency. Well, that's not a word. So then I Googled, okay, what's the antonym to complacent? And I found it really interesting that what came up is humble. So you wouldn't think that the opposite of complacent is humble, right? Those two do not feel like opposites to me.
That's almost feels just illogical, actually.
Yeah. But then when you think about it a little more, and then I was like, wait, that's weird. What's the definition of humble? So then I look at the definition of humble online, and it said not thinking much of where you are. So that when you think about humble in that definition, you go, okay, I kind of get it, right? Because complacent is happy with where you are.
Hey, I'm
Humble,
happy. I live in a nice area
mhm.
of New York. I make good money. Life's good. No, I'm not gonna push through any finish line.
So you and I talk about humility a lot, and I really appreciate you and you praise me on my humility because I do truly believe that humility is one of my superpowers, which is
Yeah.
a very big oxymoron because to call out a superpower is not a humble thing to do. But
I actually thought about the whole premise. Oh, what's my superpower? But it's like, oh, I don't know. It's like I hate saying it, but like for the purpose of it, like we all have some things that we're just
of course,
inherently very good at, and that is one of your. I mean, amongst others, I would if you had like a top 10, that'd probably be 10 on your high level abilities. But naturally so, most people who are as successful as you are not wired or cut from the cloth that you're from, which is why you'll be able to transcend where other people that are maybe close to your level are right now, long term. So
exactly. So you and I already are bought into the value of humility, and we think being humble is just a fantastic way to be. But then when you think about humble in this definition and think about basically going back to the definition, not thinking much of where you are or what you have, right? Now that is a motivating phrase. It's like, well, if I'm humble and I don't really think that I've got it all, I don't know everything, I don't have everything, there's more to do. That's a very nice base to go and get more, right? And be motivated and to go and achieve more. So it really is, I'm really just loving that concept and thinking like, wow, okay, being humble, which is you don't develop an ego, you don't get complacent, you're gracious, you're thankful, but then you also are very hungry to pursue and achieve.
so it almost seems as if from this trip you had some paradigm switches or maybe realignments internally, spiritually, emotionally. Would you say that's fair?
Well, every time I go on vacation, it just so happens to be, a trip, usually a summer trip to Europe. I come back just dying to come back and get back to work and motivated. You remember
Yes,
when
you
we
wrote a
went,
book. What are you gonna do this time?
well, last year, remember we went to Europe, and the whole time I was complaining, oh, I just want to work. I just can't wait to get home. When I get home, I'm going to write my book. I'm going to write the book. I'm going to finish the book. Right. I had procrastinated writing for a year, and all it took was some measly 2 week Europe trip. And I came back and just
All it took was
writing.
Positano to really do the trick.
Yeah, exactly. Sit on the beach for 2 days, and that'll give you unlimited motivation because you'll be so bored.
Yeah, well, especially the guy who hates summer and hates hot weather. I remember we pulled up in Cabo and we go to the beach and it was a beautiful like 82 degrees where I was like, oh God, every time I'm here, every time I'm on the beach, I just hate summer. I'm just like, you're a sicko because I crave summer more than anything else. But hey, that's why we're wired differently, I suppose.
Yeah. I just,
And yeah, any other note on kind of the trip that you were on at all?
no, no, I think that was an interesting kind of mindset share.
Yeah, what did Poland, I guess, and Romania look like? I guess, is there any other parallels you could say? Was the food? I heard I remember we were talking, you said the food was left little to be desired.
Yeah, I mean, food's okay. Nothing really wowed me on the food front.
You hear people like, oh yeah, I'm going out to get Polish or Romanian food. That's not really, I said no one ever. So
No, no, I mean the local cuisine's okay. We had the worst, I think we talked about this. We had the worst pizza, but anyhow, that doesn't matter. What was interesting, we'll end on this note, is Teddy and I we were going for a nice walk after a lunch in Bucharest, and we were walking through kind of this residential area close to this lake. It was very beautiful, and this residential area looked just like Palo Alto. It was quiet, houses were nice. It was lovely. The foliage, the green, it was very nice, and we both got a kick out of that.
Good, awesome. Well, maybe one nugget. Do you think you'd feel comfortable, and maybe not next episode, 2 weeks from now, maybe resetting some of your goals and sharing it with the audience here, maybe for the first time, just to kind of get everyone motivated and maybe set some intentions and put it out to the public?
Yeah, maybe. Let's see when we have more time for sure.
All right, awesome. Well, once more, thank you so much for tuning into this episode. We always go on this show before, like, we'll figure out a way to stretch it for an hour. And of course, I'm late for a meeting right now. But if you're interested in learning more, working with us, raising capital for us, maybe being a JV equity check writer, or looking to make a small LP investment, reach out to myself. My email is craig@lscre.com. CRAIG@lscre.com. Once more as well, if you are wanting to attend our conference, it is October 15th to the 17th. There's only about 15 VIP tickets left available, which will sell very shortly here. So their GA is basically unlimited space. So if you do want to attend the event, it's at lscsummit.com, if I'm not mistaken. So please find all the information there, stay and whatnot. And as I said, limited VIP availability left. Incredible experience if you are looking to have the upper echelon and top tier experience. Reserve cut, cigar bar, the whole nine, private access to our top clients, LP investors, and other, very, very prominent people in the space. So yeah, mouthful right there. Thank you so much for watching, and we'll see you next episode.